Hi, Scott Murray here, and welcome to the Daily Economic Market Shout for Monday, September 12th, 2022. It's great having you with me here today. It's going to be a busy week in the market. That means we're going to have CPI, PPI, and retail sales. But before we get into that, I think it's important to remember what we heard on Friday. We heard from the Federal Reserve. This is the Z1 report, which talks about household net worth. Looks at the assets, looks at the liabilities, and gives us a scorecard of where the households are today. And remember, the households are a key part of our economy. They fuel through jobs, through purchases, they fuel economic growth. So what did we see? Yes, it wasn't a good quarter. We saw $6.1 trillion in a decline in net worth, 4.1%. That's the biggest one we've seen over the last 2 years. So what drove it? Not surprising. It was a poor market, lower common stock values, escalated through the net worth. But there's really two numbers we want to think about as we move forward. One is, where is the growth in this bull market for households? Up more than 30%. And at this point in other expansions, we've never done this before. So this is the highest on record growth at this time element of this bull market. Normal, when we look at, we've been more than 2 years now in this bull market, what we see is about 20%. So yes, almost 10% more record households are doing well. Then let's look at the liabilities. Have there been a significant movement up in debt? We would kind of expect something here because things are more expensive. Average car, people paying over MSRP. That tells us that goods have been expensive. And because goods are more expensive through inflation, we should be taking on more debt, not to mention the appreciation in house prices. But where are we? We're right now at roughly 75% household debt GDP. We average over the last 20 years at 85%. So again, another barometer that tells us that the households are in really good shape. Strong households mean that purchases, that consumption, that economic growth is in the cards, even though we've had this concern about higher interest rates and recession. So we should take a step back here and appreciate how strong the economy fundamentals are. This week, we've got CPI tomorrow. We're expecting core coming in around the 3 to 3.5 on an annualized basis. It's just a monthly number, and it's in line with what we saw last month. And we clearly have a long way to go to bring that year-over-year reading, the one that goes back 12 months from where we are now, down in line with what we're seeing in the monthly readings. In addition, probably should be flat. We actually could have a step back in terms of prices. Again, oil has come down. We're seeing other commodities coming down when we look at the manufacturing sector. So that should be helpful. And then we should finish the week with a reading of PPI. It's producer prices. It was significantly lower last month. Another significant low number, or decline, I should say. What's that going to tell us? That's going to tell us that the businesses are in good shape. And rounding off the week should be retail sales, which should be a growth coming back. We've been sort of sluggish there, a little better, not rebounding from the second quarter. And this will be the second reading in the third quarter, and it should show us that gains are being made for the consumer, and then that should transfer, particularly because we've seen retail inventories move higher. And that should be an important fuel. Excuse me there. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.